I express my gratitude to you, sir, for accepting our invitation. May I now call upon CA Jayakritika to introduce our speaker of the day, CA Venkatesan. Unmute, please.
Thank you, madam. Happy evening. CA Venkatesan M hails from Chennai and is currently running his own consulting company. He is also an information system audit expert and a data scientist from Microsoft. He has led engagements in IFRS and data management from corporates for last 7 years. A renowned corporate trainer and has been associated with ICAI for numerous sessions. A man who believes to see himself into action rather than words, and so would have been the reason to have given us such crisp profile about him. Without much wait, we welcome to watch you into action on the topic for the day's CP. Over to you, sir.
Good evening, Madurai branch of SARC, and it is indeed a pleasure. Am I audible, or can I use a...
Yes, fine, sir.
So thanks for your time, and thanks for the opportunity to address every one of you here on accounting standard. It's really wonderful to connect with every one of you on the accounting standard concept. So we are going to discuss today about deferred taxes, and this is one of my very favorite standard because this believes in underlying accounting concept of periodicity, matching, and etc. So this standard is very close to my heart, and speaking about it is indeed a pleasure. And I think everyone can see my screen. So as being this is a Zoom session, I request all the members to keep it interactive. So let it not be a pure dialogue. So anywhere, any place you have a question that you want to be addressed, or you're not clear with the way that particular aspect has been discussed, I would request you to put it in the chat window so that we can discuss that at length, and so that this is really useful for every one of us. So thank you once again for the opportunity that is given to me. With this interlude, I think it's good to start the session. So this standard on deferred tax is actually not very new to every one of us. It's been there for quite a while. So this has been from 2002, and this is mandatory for all the level 1, level 2, level 3 enterprises. And this is one of the standards that was earlier brought in line with IFRS with the minute changes for a long time. So the standard is actually even before the IFRS and Ind AS came into existence in India, one of the standard that was in line with the global requirement is this standard and AS 15. Those two had almost similar concepts, and it was in par with the international accounting practices. So the standard is way ahead of its time when it was originally implemented. So this particular standard is about how are you going to account for the taxes that are deferred inside a financial statement. When we say deferred, what we actually mean is that so I'll just take a quick example. I hope everyone can see my Excel. So I like to keep it just jiggle around between the Excels and PPT so that it will be more useful for us. So let's take a very plain, simple, vanilla example. We are having a company, and its profit before taxes is, let us say, 100. Now the tax rate of this particular country for these corporates, let us say it's 20%. Just making an assumption, and this into, let us say, the surcharge, the education cess, everything. So let us just assume it is only education cess and etc. So this is my tax rate. Now, when I put what is the income tax that has been paid by this entity, invariably, it will not be equal to this number. Invariably, in 95% of the cases, it will never be equal to 20.6, because in all the global accounting practices and including India, the accounting and taxation doesn't go hand in hand. There are always differences between the way an accountant sees the books versus a tax authority sees the book. So which means that this number, when we actually look at on books, book profit, actual income tax, if you look at what is the income tax that is actually being paid, it will be invariably different between 20.6. It could be lesser or it could be more, but it never matches with 20.6. So the concept behind this particular standard is to look at this difference. Let us say this is 15, and look at this 5.6 as an item, and try to look at this 5.6 into an item that will be reversed in the future, will have an impact in the financial statement of the entity in the subsequent accounting periods, or this is an item that doesn't get any impact. So if it doesn't get any reversals in the future, what should be done? If there is a reversal, if there is a reversal in the future, what should be done? If there is no reversals in the future, what should be done? So this particular standard is nothing but describing this particular difference and argumenting about how this differences has to be held. Basically, we all know this will not match. The reason being that something which is an income as per books need not be an income as per income tax, which is a quite rare an item. But let us just draw something like this. I'm just taking a parallel between the global accounting. So income as per books, non-income as per taxes. Expenses as per books, not an expense here. I mean, the tax authority, when they say it is not an expenditure, they don't allow you to claim that as an expenditure. So that's what I mean when I say it's not an expenditure. So something is an income for books, something is not an income for taxes. This is quite rare, but there could be certain scenarios like that. Expense in the books, not expense for taxes. Then now comes the variations, like income for the books. It is also income in taxes, but not in current year, like telecommunication, license fees, and etc. Expense in books, expense not in current year. So fundamentally, when I have income and expenditure, one is prepared for the books of account for your audit, etc., and for preparation of memorandum of income tax computation, where there are certain items that would get eliminated, there would be certain items that gets added, etc., which means that something which is an income from a book need not be an income for taxes. In India, this scenario is very rare, but there are scenarios in global parlance, which is where you have an income for books, but the tax authorities gives you an exemption that this is not an income. An agricultural income could be an example in India. So it is an expenses as per books, but as per the taxes, it is not at all an expenditure. You cannot claim that expenditure. And there are certain items where it is an income for the books, but it's not an income in whole for the current year as per the income taxes. The later part, it is an expense for the books, and it is not an expenses for the current year. Because of all these reasons, all the reasons that could be clubbed to one of these categories, we have differences between the tax rate applied on the profit of the company or of the entity and the actual tax that this entity is required to make a payment. So this difference is always existing. Now, what we are going to do about this difference in our accounting financial statements is what the standard is all about. Now, a very primary question: why at all an accountant, or why at all someone has to be bothered about recognizing something as a deferred tax asset or a deferred tax liability? This is something that is a very fundamental question. Why at all I have to recognize it? Let us say income tax on book profit is 20.6. Income tax on actual income tax paid is 15. And the difference is 5.6. Let us not bother about it. Let us say 15 as our taxes and go with it. Why at all we have to evaluate this 5.6? And we have not discussed what we're going to do with the 5.6, but why at all there need to be a deliberation on 5.6, and also looking at why that has to be accounted, why those impacts have to be studied. First, the back away. Is it okay if I use the vernacular languages as well? I just take the liberty because it is Madurai branch of SARC, or someone tell me in the comment?
No, that's absolutely fine, sir.
Okay, super. So, Tamil Vadatha Sangam Uru. So we'll use, I'll just use it sparingly. First is the account பண்ணணும். இதுக்கு ஒரு ரீசனே இல்லையே, நம்ம பண்ணாமே இருக்கலாம். The whole question, நம்ம எதுக்கு இத பார்க்க ஆரம்பிச்சோம்? The whole question itself is, when I have 100 rupees as profit, when I apply the tax rate, I get certain number as the income tax value. And the income tax authority says, no, that is not the value of the tax that you have to pay. There is a different value. There is a different method by which you have to compute the taxes. The way you compute it may not be the right approach or the acceptable approach for the tax loss. And then we come out and say, okay, we will come out what is the computation as per income tax. They say 15 is the taxes, or let us assume 24 is the taxes. Now the question is, in the rendathoda differential eduthu, we ascertain certain aspects. We study that 3.4 எதனால வருது, அந்த அது எதனால வருதோ அதை கேட்டகரைஸ் பண்ணி அது இப்படி இருந்தா இந்த மாதிரி அக்கௌண்ட் பண்ணணும், அப்படி இருந்தா அப்படி அக்கௌண்ட் பண்ணணும்னா is what we are going to see in the standard. But the question is, why at all we need to do that? அது எதுக்காக பண்ணணும்? பண்ணவே தேவையில்லையே. அப்படியே இங்க இன்கம் டாக்ஸ்ல என்ன இருக்கு, 24 இருக்கு, 24 அக்கௌண்ட் பண்ணிட்டு போயிட்டே இருக்கலாமே, எதுக்கு இதை ஸ்டடி பண்ணணும்? This is a very fundamental question. Why at all the standard is introduced in as a concept? So because it is always difficult to do this. நமக்கும் ஒரு புது ஸ்டாண்டர்ட் எடுத்து அதை அக்கௌண்ட் பண்ணி அதோட டெலிபரேஷன்ஸ் எல்லாத்தையும் பார்த்து எதுக்கு இவ்வளோ மெனக்கிடணும்? So there is a valid reason for it, why the standard has been introduced actually, and why this deferred tax is actually an interesting concept, and why it has to be deliberated and accounted. So I'll just take a very simple example. Profit. We know that fundamentally one item that will be different in the financial statement and income taxes, irrespective of a small company or a big company, whether they have any differences in taxability in terms of 43B, 40A, IA, blah 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 stuff. Even if they have it or not, one item will always be different. That is depreciation. We cannot get away with it because the rates in Income Tax Act and the rates in Companies Act are entirely different. So let us just take that as an example. So this is profit before depreciation. So let us take Companies Act depreciation. So this is going to be 20, and profit after depreciation is 80. Now you have Income Tax Act depreciation. I am just presuming that income tax depreciation is little bit on the higher side. So which is, let us assume it is 25. So there are no other differences between income taxes and Companies Act. Now let us try to look at how we do this practically in our income taxes. So what we will do is we'll take 80 as the profit, add back Companies Act depreciation, and subtract income tax depreciation. This is 75. On, let us say, the tax rate in the entity ki 20%. 20%. So $15 is the taxes. So EBA, profit after tax. Now let us assume something very simply, that this standard is something that is drawn from global entities. In India, you have restrictions on dividends. Globally, there are no restrictions on dividends. So now let us get back to our scenario. This is year 1. Profit. It will be 80. Taxes. Let us assume deferred tax is not there. 15. Profit after tax. Now, assuming there are no restrictions on dividends, in terms of the profitability of the entity and things like that, I can distribute the entire profits as dividend. Right. So I have distributed this as a dividend. So I have no money that is left on my hand. Next year, the signs change. There is a flip on the depreciation. So it generally happens. So, for example, let us say ஒரு asset 200 rupees we use SLM for Companies Act, and SLM is 10 years. 10 years, maybe let's take 8 years. And WDV, say, let us say this is 5 years. So 200 is asset value. So Companies Act depreciation SLM year on year, I'm going to put it. It will be assuming there are no residual values. So WDV. So I should amortize it by 5 years. So 20% should be my approximate depreciation. I'll just put 20%, then even it out. 20% is the first year depreciation. Then second year it's going to be 20%. Maybe I should have assumed 25%. So I still have some more depreciations. I'm just observing, okay, there is 15, a little bit higher percentage. I want the Companies Act to be a little higher. I'm observing this entire asset value, so it becomes 0 in this current year. So this is year 1. So this asset, assuming there is no other asset in the block, this asset gets absorbed by 8 years, and the same asset will come for 12 years in the Companies Act. Just for our example, we are flipping sides. What happens is we are getting the second year. Second year, the profit is 90. This time, let us assume the Companies Act depreciation is actually not 20 or 50, because there are various assets that it might have. And the income tax, or we can even assume it as 20. The income tax depreciation, because of the WDV impact and as such, it is only 20. Just making an assumption. I'll go to year 2. My profit is going to be and let's 20%, 56. Now, here I need a bit of attention. The attention is, in this scenario, even if I am going to make that my profit is only 5 rupees, there is a loss, there is a minimum profit, which is 5 years, 5 rupees. I might still have to pay taxes on this. Or I'll make it as 10. Where this will become equal to 0. Even if I have 20 rupees as profit, so income tax depreciation is, and income tax depreciation is Profit before depreciation is 0. Add back 20, subtract 15. Even if it is 25. Okay, let us assume the same rates. Profit after depreciation becomes 0, and I have the same companies at depreciation. Literally, I have made no profit. I have made no profit. After income tax, I have made no profit. I am having an income tax depreciation. I had minimum profit. I had companies at depreciation. Even then, I might have to pay taxes. This profit is actually 35 minus 20 is 10 rupees profit, and 30 minus 20, which is 10 rupees. My taxes is at 1. Ideally, this 1 rupee tax that I'm paying, is not on account of my own profits. See, here I have 10 rupee profit. If I apply 20%, it is only 2 rupees. This profit on tax that I'm paying is ideally not on account of the profit that I've earned in the current year, but on account of the profits that is created on account of my change in the depreciation value. I would ideally pay less tax, but because of my change in the depreciation, I'm ending up paying more tax. Here, I would have ideally paid less tax, but because of my depreciation impact, where this, I've kept it an equal example, even if I reduce it a bit, I might have more taxes that will exactly signify this. So 2.5 is my I am ending up paying more tax purely because of my change in the depreciation. So the concept why this deferred tax is introduced is, here in this scenario, I am paying less tax purely on account of I am paying less tax. Company 80 ரூபாய் profit பண்ணிருக்கோம், ஆனா நான் tax கட்டறது நீங்க பாத்தீங்கன்னா 75 ரூபாய்க்கு தான் கட்டறேன். அப்போ நான் இப்போ என்ஜாய் பண்ற surplus எவ்வளவு? 5 ரூபாய். In the 5 rupee surplus which I am enjoying is not my permanent enjoyment. This 5 rupee is bound to get reversed. It's bound to get reversed. Is bound to get reversed in the subsequent period. When it gets reversed in the subsequent period, in this year there is no surplus like this. Next year this will become 15. Or இப்பவே 15 ஆக்கினீங்கன்னா, this is bound to get reversed in the subsequent period. When I have that reversal, I am paying tax on this 5 rupee, while I would not have earned that in that rupee in that year. In the case எடுத்துட்டீங்கன்னா 20% profitல tax பண்ணிட்டா 16 ரூபாய் tax வரும். ஆனா I am paying up tax how much? 17. In the 1 rupee tax extra I am paying is not profit that I have earned in that current period. This is nothing but this depreciation reversal impact. இந்த வருஷம் profit சம்பாதிச்சு அந்த வருஷம் profit ஓட impactல tax கட்டல because of the depreciational differences between income tax and companies act, which is the reality. And if I am not going to have a standard on deferred tax and it is going to continue as such, ஒரு இயர்ல பண்ண profit பூரா நான் distribute பண்ணிட்டு taxes only on income tax computation padi pannina, these items which are bound to get reversed. ஏனா இப்போ இந்த எக்ஸாம்பிள்ல பார்த்தோம், it is bound to get reversed. First yearல companies act depreciation 25 ரூபாய், income tax act depreciation 70 ரூபாய், which means that I am having 45 rupees on which I need not pay tax. இத அப்படியே drag பண்ணிட்டு போனா இது ஒரு பெல் கர்வ் மாதிரி வரும். 45 20 40.8 இங்க ரிவர்சல் ஆகி அப்படியே ரிவர்சல் ஆகி ஸ்மால் போர்ஷன்ஸ் சப்சிக்வெண்டா திருப்பி ஒரு கெயின் வர மாதிரி வந்து மொத்தமா பண்ணா 0 ஆயிடும். So if you plot it as a graph it will become a ஒரு பெல் கர்வ் மாதிரி ஒரு கிராஃப் வரும். Ideally, in the 45 rupees gain is not a real gain for me. In the gain subsequent period, the reverse ஆகும்போது நான் இந்த வருஷம் இந்த கெயினை ஃபுல்லா யூஸ் பண்ணிக்கிட்டு டாக்ஸ்ல வர கெயினை ஃபுல்லா யூஸ் பண்ணிட்டு இப்போ டாக்ஸ்ல வருதுன்னா இது 20% வரும். இந்த டாக்ஸ் கெயினை நான் ஃபுல்லா யூஸ் பண்ணி இந்த 9 ரூபாயை நான் டிவிடெண்டா டிஸ்ட்ரிபியூட் பண்ணி இஃப் ஐ ஆம் கெட்டிங் இட் அவுட் ஆஃப் த கேஷ் சிஸ்டம், subsequently when I am bound to make tax payment purely on account of this reversal like this. இப்போ நான் இங்க ஜெனரேட் பண்ண ப்ராஃபிட் அதே 80 ரூபாய் தான், ஆனா என்னோட இன்கம் டாக்ஸ் டெப்ரிசியேஷன் குறைஞ்சிருச்சு. குறைஞ்சதுனால என்னோட டாக்ஸ் அதிகமாயிடுச்சு. ஏன்னா இது பவுண்ட் டு ரெடியூஸ். இன்கம் டாக்ஸ் டெப்ரிசியேஷன் ஒரு வருஷம் அதிகமா இருக்கு கம்பெனி டாக்ஸ் டெப்ரிசியேஷன் அப்படின்னா இன்னைக்கு இல்லைனாலும் சப்சிக்வெண்டா ஒரு பீரியட்ல இந்த பொசிஷன் ரிவர்ஸ் ஆகும். ஒரே ஒரு அசெட் இருந்தா தெரியும். பிகாஸ் we are having multiple sets of assets, the company is constantly buying assets, the company is growing, you will have more and more assets getting added. This is not quite visible for us on a realistic note. அத நம்மளோட every year finalizationல நம்மால இத ஒரு observable element பார்க்க முடியாததுக்கு காரணமே என்னன்னா it is purely because in the assets gets constantly added. It is not a single asset, single block and etc. So உங்களுக்கு அது அசெட் ஆட் ஆகிட்டே இருக்கும். ஸோ பிளாக் பெருசாகிட்டே இருக்கும். ஸோ நமக்கு தெரிய வராது இது ரிவர்ஸ் ஆச்சா இல்லையான்னு. பட் ஒரு அசெட் அப்படின்னு எடுத்து பார்த்து ஒரு எக்ஸாம்பிள் எடுத்து போட்டோம்னா 100% ரிவர்ஸ் ஆகும். இந்த ரிவர்ஸ் ஆகும்போது நான் பே பண்ற டாக்ஸ் இந்த இயர் இன் விச் இட் இஸ் கெட்டிங் ரிவர்ஸ் இஸ் நாட் அ டாக்ஸ் தட் ஐ எம் பேயிங் ஆன் த ப்ராஃபிட் earned in that year, but it is purely because of the reversal that originated in a year for which I have enjoyed the benefit and left. ஸோ இந்த கேஸ்ல இந்த 1 ரூபாய் டாக்ஸ் நான் எக்ஸ்ட்ரா பே பண்றேன்ல. இப்போ ஐடியலி நான் 16 ரூபாய் தான் பே பண்ணிருக்கணும் இந்த வருஷம் ப்ராஃபிட்ல, ஆனா நான் 17 ரூபாய் டாக்ஸ் பே பண்றேன். ஆக்சுவலி ஏன்னா போன வருஷம் நான் 16 ரூபாய் பே பண்ணிருக்கணும் டாக்ஸா, ஆனா நான் 15 தான் பே பண்ணேன். ஏன்னா எனக்கு இன்கம் டாக்ஸ் டெப்ரிசியேஷன் டிஃபரன்சஸ்ல எனக்கு ஒரு 5 ரூபாய் கெயின் கிடைச்சது. இந்த 5 ரூபாய் கெயின்னால என்னோட டாக்ஸ் 1 ரூபாய் குறைஞ்சது. இந்த கெயின் ரிவர்ஸ் ஆகும்போது நம்ம எக்ஸாம்பிளுக்காக அடுத்த வருஷமே ரிவர்ஸ் ஆகுதுன்னு போட்டுப்போம். இட் நாட் கெட் ரிவர்ஸ் சப்சிக்வெண்ட் இன் நெக்ஸ்ட் இயர் itself. It depends on the asset, in a category, etc. So it may get reversed in another period. So in the reversal agara year the tax that we pay is not on account of the profits earned in that year, but it goes purely because of the depreciation difference. Ipo let us take the same example after introduction of deferred tax. Ipo na inga dividend la distribute panni start aache, the 65 rupees ku dividend la distribute panniyache. In this scenario, when I have to pay taxes, the profit irukku, that's not a different story. But this 1 rupee gain, what I have enjoyed in this year, I have also enjoyed in that year itself. Ideally, I should not have enjoyed because I should make a reserve to that extent, because that's not something that is going to be there with me permanently, and that is also because of the current year profitability. So to that extent, I have to create a reserve. That is what we call it as deferred tax asset or a deferred tax liability. Now, if a deferred tax introduce பண்ண போறோம் என்ன ஆகும்? I'll take the same example. இப்போ taxes I will segregate it into two parts. So இங்க 1 வந்துருச்சு, 5 15 வந்துருச்சு. இப்போ assuming for a moment why there is a deferred tax இதுக்கு அப்படிங்கிற எக்ஸாம்பிள் அந்த ரீசனிங் ஸ்டாண்டர்ட்ல என்ன இருக்குங்கிறதுக்கு அப்புறம் போகும், because every one of us know depreciation யூசுவலா போடுவாங்க. So I'm just putting this. So my tax will be not 15, it will be 16. I will only take dividends to the extent of 64 because that is what is my PAT. In this year, it is getting reversed. So in the case if you see the difference between these two, if you have deferred taxes, if you don't have deferred taxes, we might end up absorbing all the profits of that year, while the reality is not all the profit that you have generated is a profit of that year. Some of it is purely an impact on the differences between certain items which will get reversed in the future. So far good to go. Why at all deferred tax? Any questions till now? Any concepts, any discussion? I'll keep the chat window open. Any points for discussion, or we'll continue further?
So you can go ahead, sir.
So, in deferred tax, first question I would answer, because profit, one is the matching concept, periodicity. In the version profit nala vara tax oda impact in the version account aanum. That is the first reason. Second reason, adu yen pannanom? We have to do it because the differences that you enjoy between your tax rates and accounting rates, whatever is the difference, either it could give you a positive result or it could be a negative result. Both of that is bound to reverse in the future, unless and until we create a reserve, because deferred tax is a non-cash entry. Because it is a non-cash entry, if I inga poite enoda PAT reduce pannadhunala enoda cash reserve kammiya porudhu, cash அப்படியே தான் இருக்க போகுது. So which means that my ideal cash would be 65 only. It will not become 64. But what I am doing is I am creating a reserve indirectly, because there is no cash impact on account of deferred taxes, and the item will be eligible when I have to pay it in the next year, because that year is not purely on account of that year's tax impact. First, periodicity, even out. In the version tax, in the version account on. That is one reason. Second is that we are creating an indirectly we are creating a secret reserve as a cash, which will not get used to pay off dividends or something like that in the current year itself, which will be useful when actually there is a reversal in the taxes. These are the two main reasons why we are creating a deferred tax. So on what it is not applicable, that is quite simple. It is not applicable on distributions of dividends and other distributions by the enterprises, because in these cases you don't have an accounting and a tax impact, because these are purely on account of originated. This is a special levy that is being charged by the income tax departments. There is no accounting differences between that, because ஒரு இடத்துக்கு ப்ராஃபிட் இன்னொரு இடத்துக்கு ப்ராஃபிட் இல்லாம, or இந்த இடத்துல எக்ஸ்பென்ஸ் இந்த இடத்துல எக்ஸ்பென்ஸ் இல்ல, அந்த மாதிரி ஒரு dual concept, இதுக்கும் அதுக்கும் ஒரு ஆப்போசிட் எலிமெண்டே வராது. So it is dividend in both the cases. It is not allowable in income tax act for both the cases. So in those, it doesn't specify any accounting for tax payable on those items. Other distributions are your dividend distributions, any other distribution that might occur, like preference dividends and etc. Okay, so now the standard is actually segregating, introducing a concept called temporary differences or timing differences and permanent differences. So we saw why we are creating deferred tax, on what we are going to create deferred tax. If you borrow the language from the IFRS and etc., it is nothing but differences between items of income or expenses. We call it tax assets, asset based or liability based. Items of income or expenses versus difference between incomes of differences as per books and as per taxation. These are on which we are going to either do a deferred tax or not do a deferred tax. This is our point of concept, which is going to get further segregated and evaluated. Now, this is segregated into two categories as per the standard. One is called timing difference. The other is called permanent difference. Timing difference is something like this. The difference which just created in 1 year is going to get reversed in a subsequent year. That is a timing difference. This difference which is originated in 1 year will get reversed in another year. Actually, இப்போ இங்க பாத்தீங்கனாலே இது reverse ஆகுது. 20, 25, 4.5. So let us put it cumulatively so that we will know the difference. So here at this point it gets reversed. 17 ங்கிறது 64 ஆயிடுச்சு, 51 ஆயிடுச்சு, 34 it gets reversed. Cumulatively, if you see, it gets reversed. So item that is expected to be reversed in the future, இங்கதான் மேல இங்கதான் reverse ஆகுது. point of reversal. Subsequently, it is estimated, it is expected to be reversed. Then it becomes a timing difference. Anything that is not going to get reversed in the future. Reverse na enna artham? In the varsham, I had more depreciation in Income Tax Act, correct? So, which means that this difference nala I might save taxes. But in the difference will become a positive difference in a subsequent year, which means I'll end up paying more taxes in that year. So this is what we mean by reversal. So differences between taxable income, accounting income originating in one period, capable of reversal in one or subsequent periods. That is what we call it as timing differences. Differences that will not get reversed subsequently. Good example is donations in Income Tax Act, which are not allowed under Income Tax Act. Your penalties and levies which are not allowed under Section 35, and certain deductions that are available under 80 HSC. Now, I don't think so the section is allowing it, but these are some of the differences. Like you have a accelerated depreciation in Income Tax Act. You might have an accelerated deductions for scientific research expenditures and etc. Those items which are not expected to be reversed at all. That difference, once that difference is there, it's a lottery. It's always there. Or the difference is a penalty that we have to pay. And the Andamari differences are called permanent differences. So, for the standard first segregates this into timing difference and permanent difference. Now, what happens is, if there is a timing difference, we create a deferred tax asset or a liability to that extent. If the difference is permanent, we don't create anything on account of that. This is a very simple one. Timing difference, we create a deferred tax asset or a liability. If there is a permanent difference, we don't create it. In India, in our existing accounting standards, there is nothing called as tax reconciliation reco. Or tax reco abdino or concept. But in global standards, in India and IFRS, there is something called as permanent tax rate reco. So in the tax rate reco, just give an example. Let us say book profit 225. Now this is, I will add back Companies Act. I will reduce Income Tax Act depreciation. This is good to have actually, even if the standard doesn't prescribe this particular concept. In our practices, whenever we do audit, if we create this, it will be a very good exercise for us as well. So now I have created this. Then I have, say, let us say I am adding back 40 a year disallowance. I'm reducing something as 43B disallowance. Oh, sorry, I will add back 43B disallowance in this current year. And I'm adding back, let us say, section 37 penalties. And let us say I'm reducing the accelerated charge on 125% on scientific research expenditure. Now, what are the other items? Any more example? One or two? Any more example? Okay, I'll have to add back AS 17, AS 19, lease equalization. So actually, just to draw a parallel, if the lease rentals, the standard says we have to, let us say, the first year as per the agreement it is 100. The second year as per the agreement it is, let us say, 100. Every 3 years, let us say there is a 10% hike. And say the contract is for 12 years. So what our accounting standard is asking us to do is, it has to be straight line. So every year your impact, your books will have an impact of 103. But in income tax, you are allowed only item that you actually pay. So I might have to add back equalization levy and subtract the actual payment. So that is something that will also just enable you to create a deferred tax. So let us take this as an example and start working on something. Let us say 50. What else? Anything else that we can have? Let us keep this for a moment. Tax rate. Okay, let us take donation disallowed. Donation 80G non-claimable. So, or 50% is only eligible. So there is a 50% that I have to add back. Now I have a 10% or a 20% as my tax rate. So I'm just assuming my Companies Act depreciation is 50, Income Tax Act depreciation is 75, 40 disallowance is 20, and disallowance under this is 10, and penalty is 10. Scientific research expenditure is, let us assume actual expenditure was 50, or let us assume after expenditure was 30. So I would be eligible. The 30 is already claimed as a deduction. So in this 225 itself, the 30 rupees will be there. So I have to only be eligible to claim that accelerated one, which is 7.5. I hope you get here, because this 30 is an actual expenditure that I have already deducted here. So the 125%, which is an accelerated, I will be eligible only for this 25% excess. So adana subtract panikiren. Practically reduce it. And so maybe I'll take this example as 25. So in actual books, I would have claimed 20.883. I should add back. Actual payment is, let us say we are in the third year, so I'm making an actual payment of, okay, I will take it as a first year, it's easy to do. So 25. So this is my memorandum of income. Assume pannipom. Okay, there are certain items that I have not touched upon, like there could be a 40A IA disallowance in the last year, which I can claim it in the current year. There are certain 43 disallowance that I would have made in the last year that I can claim it in the current year. I'm not going into it. I'll come to that a little later. Okay, donation not allowed. So 50% is what is claimable. So this one is scientific research. Scientific research. And 2%. And 80G, let's take 100. So 50% of it is only allowed. This 100 is already deducted here. So I will not deduct it again. I will just have to add back 50% of it, because 50% is only eligible. So either I can add the entire donations and put only 50%. I'm just saying I have to add back the original depreciation. So 50 is to be added because 50% is only allowed. So the difference between these two is added. So this is my taxable income. $64. So now I'll put a profit after tax, profit before tax and after Companies Act depreciation 175. I will have something called as current taxes. I'll have something called as deferred taxes. Current tax is plain and simple. So I just assume there's no education charges or something like that, just for our example. 64.67. Deferred taxes in Abdina. So now I have to categorize these differences. Timing, permanent. This one timing now. If you see, the difference will get will become 0 in 1 year. So this is also a timing difference only. The lease equalization is also a timing difference. It's not a permanent difference. So this is permanent. So ennalam timing difference irukku. This plus this plus this plus this plus this plus this 43. 45 is the entire timing difference. 9.1. So actually it's a reversal level. You know, if I'm ending up paying more taxes, I'll just filter out what are the timing differences and then try to find out whether it is an asset or a liability. So in the timing differences or a subtotal quota, 45 is my timing difference for a reason. So which means that my 225 is increased by 45 minus 25. இதெல்லாம் add ஆகுதுன்றதுனால I am having the actual payment is 25, not 5. That's good. Actual payment will be 25. Okay. 15 is my timing differences. So 15 is actually getting increased. So which means that I am ending up with I am paying more tax in the current year, but this is subsequent to be reversed. So it is a deferred tax asset for me. So I'm reversing it because your difference pathina and taxable income is only increased by this item. So it's a deferred tax asset for me. So my profit after taxes is 230.50. So now what I have to ideally do is now I'll do something called as reco. I'll take profit, which is 125, 175. I apply the tax rate 35. 35 should have been my charge, correct? But my charge is 55, correct? Current tax and deferred tax charge, it is actually 55 for me. But ideally it should only be 35, correct? Current tax impact panniten, deferred tax impact panniten. So in the renduthiyum pota enak 55 dhaan varanum. So ஒரு example க்கு ஏன் அது 55 ஏன் அது 35 வராம 55 வருது அப்படினா permanent differences இருக்கிறதுனால. I hope this point everyone is clear. What I'm trying to do is I'm trying to do a reco. I'm taking my tax rate order taxable profit before tax multiply panna, I'm getting a tax value. Ideally this value should be there, assuming there is no difference between accounting and taxation, but there are differences. In the differences kaga dhaan deferred tax concept introduce பண்றோம்னு சொன்னோம். And deferred tax நம்ம ரெண்டா பிரிச்சிட்டோம். Differences, whatever is timing, whatever is permanent. Timing differences க்கு impact பண்ணனும்னு சொன்னோம், impactum பண்ணியாச்சு. Ideally now my number should be 0, but the number is not 0. So what I will do is I will see what is my difference, 20.50, correct? Now I will take all the items that is causing the permanent difference. Take the same tax rate, multiply it. So the ideal way is I'll take all the differences, item that is causing the difference. What are the items that is causing the timing difference? What are the items that is causing the permanent difference? I'll take profit before that. $293, which I have left. $293. Apply the tax rate. The tax rate 58.67. This is my tax, overall tax. In the tax law, I have to subtract this because this will get subsequently reversed in the future. So 55.5 is my actual tax rate. Now I have to put a reco, that is profit before any of the adjustment items, which is 225, which is arriving at 45. I take the difference between that and the deferred tax. It should match with my permanent difference. Ideally, this would be correct when we are doing for the first year. But subsequent year, there could be certain differences, like சில வருஷம் deferred tax விட்டுருப்போம், சில வருஷம் deferred tax கலைச்சா எடுத்துக்க மாட்டோம், போன வருஷம் deferred tax ஒரு ரேட்ல கம்ப்யூட் பண்ணிருப்போம், இந்த வருஷம் deferred tax இன்னொரு ரேட்ல கம்ப்யூட் பண்றோம். So ideally it will not match. So the difference should be so minute. It should not be so high. With the exact time tally ஆகும், because we are doing for the first year, so there are no issues on it. So subsequent years panna this permanent difference or exact impact might not be exactly equal. There could be certain slight difference in that, but it is okay. We should ensure that difference is so minute. It's not so elaborate. That is the rule of thumb that we have to test ourselves, whether நம்மளோட difference, timing difference and permanent differences or impact எடுத்து போட்டு பார்த்தா நம்மளோட tax rate reco match ஆகுதா. This is what we call it as tax rate reco. Under Ind AS and IFRS differences, standard, the mandatory, we have to put this in the financial statement itself and give. India, it's not that prevalent, but it's in the standard is not asking us to maintain this particular reconciliation. But for the best practices and for us to get into a control, this is a very good exercise. Clear on this, or you want me to compute it again and show you? Clear on this, sir? Or we can do it again. You can put your views on the chat window. Anyone? Okay, so I'll continue further.
Yes, sir.
Yeah, sure. So this is a very simple exercise to put on a permanent tax rate reco. எவ்வளவு டிஃபரன்ஸ் வருது, என்ன காசு ஆகுது அப்படிங்கிறதுக்கு, வாட் இஸ் காசிங் த டிஃபரன்ஸ்ங்கிறதுக்கான ரெகன்சிலைசேஷன் தான் இந்த பர்டிகுலர் ஐட்டம். ஸோ தேர் ஆர் டைமிங் டிஃபரன்சஸ் அண்ட் தேர் ஆர் பெர்மனன்ட் டிஃபரன்சஸ். டைமிங் டிஃபரன்சஸ்க்கு டெஃபர்ட் டாக்ஸ் கிரியேட் பண்றோம், பெர்மனன்ட் டிஃபரன்சஸ்க்கு கிரியேட் பண்ண போறது கிடையாது. ஆனா பெர்மனன்ட் டிஃபரன்சஸோட இம்பாக்டை எடுத்து டாக்ஸ் ரேட் அப்ளை பண்ணி we do a reconciliation to know that are we doing everything correctly. Okay, so the standard further defines what is a tax expense. Tax expense is current tax plus deferred tax. In the ரெண்டுத்தையும் சேர்த்து together it is called as tax expenses. And prudence on deferred taxes will come to that. So deferred taxes should be recognized for all timing differences. Whatever differences that we are saying is as timing, we have to create a deferred tax asset or a liability. But when it is a deferred tax asset, then we need to be a little bit prudent. In the இடத்துல we are creating actually a deferred tax asset, because நம்மளோட tax is coming down, which is something that we are creating a deferred tax asset. So there is a concept of prudence attached whenever we are creating a deferred tax asset. So okay, so what is that we are going to do on when it comes to prudence? Okay, so I'll do that. Okay, so what is something that we have to do when we are creating a deferred tax asset on account of these items? Okay, first of all, deferred tax asset எப்போ ரியலைஸ் ஆகும், எப்போ கன்சிடர் ஆக போகுது அப்படின்னா, when you are paying excess tax in the current period on account of the differences between accounting profits and taxable profit on account of income and expenditures and etc. But this particular difference is giving you an impact in such a way that you are paying more tax, you are ending up paying more tax, but it will get reversed in the future. So that is a case where you will have a deferred tax asset. In our example, if in the example நம்ம பார்த்த கேஸ்ல we are having a deferred tax asset. ஏன்னா all timing differences is actually adding up to a positive number, which means that my taxable income is higher, is increased by these timing differences. So these timing differences, when reversed in the future, it will end up in a deferred tax asset for me. Now the standard says if the situation is flipped, don't think too much. If the situation is flipped, don't think too much. But if the situation is like this, where you are ending up with a deferred tax asset as a position, the standard says be cautious. So on account of your normal item, there will be two possible scenarios. One is deferred tax liability and deferred tax asset. Okay, first of all, இப்போ நம்ம timing differences மட்டும் எடுத்து பார்த்தோம்னா, these two is originated on account of single item called depreciation. This is giving you a deferred tax asset. These three, if you see, it is creating a deferred tax liability. Can these be set off? That's the first question that we have to answer ourselves. இப்போ இதோட கேஸ பார்த்தா DTA இது ரெண்டுத்தையும் எடுத்தா, இதை எடுத்தா DTL, இதை எடுத்தா DTL, இதை எடுத்தா DTA, இதை எடுத்தா DTA தான் நினைக்கிறேன். இதை எடுத்தாலும் DTA because you're paying more tax. So இது DTA and DTL இதெல்லாம் செட் ஆஃப் பண்ணி நெட்டா வர DTL ஓ DTA ஓ ஃபர்ஸ்ட் அலவுடா அப்படின்னு கேட்டா ஸ்டாண்டர்ட் சேஸ் இப்போ இந்த ஒவ்வொரு ஐட்டமும் இட் இஸ் செல்ஃப் அட்ஜஸ்டபிள். இதெல்லாம் ஒரே டாக்ஸ் ஜூரிஸ்டிக்ஷன் கீழே இருக்கிறது, எல்லாமே இன்கம் டாக்ஸ் ஆக்ட் கீழே தான் இருக்கு. இது ரெண்டத்தையும் செட் ஆஃப் பண்ண முடியும்னா you're allowed to do, assuming this is not set off against each other. அதாவது இந்த ரெண்டு ஐட்டமும் செட் ஆஃப் பண்ண முடியாது அப்படின்னா இண்டிவிஜுவலா தான் நம்ம கிரியேட் பண்ணிக்கணும். If these are eligible to be adjusted against each other, then you are allowed to say a net amount. Netta and or the deferred tax asset or liability you are allowed to keep. But if this cannot be set off against each other, then we are not allowed. Very good example. We have a foreign branch, and the foreign branch or accounting எடுத்து பார்த்து அந்த கண்ட்ரியோட டாக்ஸ் லாஸையும் எடுத்து பார்த்து இவாலுவேட் பண்ணி பார்க்கும்போது let us say it originates a deferred tax asset or liability. Your local branch or a company has a deferred tax asset or liability. The foreign branch or deferred tax asset and liability இதையும் நம்மால knock off பண்ண முடியாது. And the deferred tax is on account of a jurisdiction which is not governed by the same jurisdiction of other branches. அதனால இது ரெண்டுத்தையும் செட் ஆஃப் பண்ண முடியாது. எப்ப செட் ஆஃப் பண்ண முடியும்னா ஆர் எப்போ நெட்டா நம்மால அதை காட்ட முடியும்னா where both are claimed under a single act or both are set off against, eligible to be claimed against each other. In those scenarios only we are allowed to keep deferred tax assets and deferred tax liabilities together in a net position. Otherwise you are not allowed. So this is something that we have to note on the standard. So now if it is deferred tax liability, you say created. If it is deferred tax asset, it could be created on account of two things. One, I am having expenses or income differences between the taxability and accounting profitability, which is creating a deferred tax asset on account of operations. I just name it. This name is not used in the standard. But you could also have a deferred tax asset on account of losses. So this year the company has made a loss. This is eligible to be set off against the future profits of the company. Even in that scenario, I am eligible to create a deferred tax asset because in the what loss, this loss will be used in the future, which means I will be eligible for set off of these losses in the future. So I might end up with a tax position in the future. So I'll create a deferred tax asset now, reverse it when the taxes are becoming normal. Now, the standard is giving you two things. One, when you're creating deferred tax asset on account of operations, or you are creating a deferred tax asset on account of losses, keep prudence. In operations, keep prudence. What do you mean by prudence? If in the example, 58.26 is the value, which is 15.83 is the difference between timing differences that is originated on which I have to create a deferred tax asset. The standard is asking us to evaluate in the 15 ruba which is we have created, will it be used in the future? Tomorrow they should have some profits or taxable profits in which they can claim this. Ideally in this scenario what would happen in the subsequent year? Let us say this is year 1. Let us go to year 2. Let us say they made a profit of 100. இதே companies at depreciation 75 அப்படியே வச்சுப்போம். இது அப்படியே ரிவர்ஸ் ஆகுமா? ரைட், இது ரிவர்ஸ் ஆகும். This will remain the same னு வச்சுப்போமே. இப்போ இந்த ரிவர்சல்ஸ் இருக்குல்ல, which is 40 to that extent, இந்த 40 ரிவர்சல் should be eligible to be absorbed. இப்போ next year என்னோட ப்ராஃபிட்டே 0ன்னு வச்சுக்கோங்களேன், ப்ராஃபிட்டே பண்ணல அந்த என்டிட்டி, இதோட ஆட் ஆன் எனக்கு லாஸ்ட்ல கொண்டு போய் விடும். That is 64.24. It's just theoretical example, but we have to keep a caution that in the profit, will there be a profit in the subsequent period, which they will have a utility to use this difference and claim that. One question is, எப்படியும் இந்த 64.4 லாஸா வரும், அந்த லாஸ் எப்படியும் நான் deferred tax asset கிரியேட் பண்ணலாம், அந்த லாஸ் எனிவேஸ் எனக்கு யூஸ் ஆதான் ஆக போகுது. Yeah, so அதுக்கு ஸ்டாண்டர்ட் இஸ் ரிப்ளைங் in the next point. So we'll first know this point. இந்த லெவல்ல prudence அப்ளை பண்ணி இது ரிவர்ஸ் ஆகும் அப்படின்னு நமக்கு it will be evidencing that it will get reversed in the future. Standard is saying create deferred tax asset. Otherwise, standard says don't create deferred tax asset. Now, an argument is, இப்போ இங்க 64.16 இருக்கு, which will be a loss that this entity has suffered, even if they have no profit because of the reversals of etc. This is a loss that this entity has suffered. This loss is anyway eligible to be carried forward in the future. Yeah, for that losses also, the standard is saying, the future losses also, the standard is saying, create deferred tax, there will be a future income. There will be a future income that will be eligible to be set off here, where they use a term called virtual certainty to support that this loss will get utilized in the future. I have a very good example, which for an entity for which we are doing IFRS in the Ind AS in the near future, which we have been doing. For this entity, we've been doing work from 2017, from the year in which they have established. So 2017, they had a book loss. I'll just, these numbers are not real, just concept is what is critical here. Book loss and depreciation loss. Book loss was 100, depreciation loss was 70. All these are end of the financial years. So what has actually happened is, just note the concept alone here. இப்போ இந்த என்டிட்டி 5 வருஷமா 6 வருஷமா லாஸ் தான் பண்ணிட்டு இருக்கு, ஆனா லாசஸ் குறைய ஆரம்பிச்சிருக்கு, எக்ஸப்ட் in the year in which they had COVID. In which they had COVID, every year they had started making good profits, or the loss in which they started, originally first year இவ்வளவு லாஸ் பண்ணாங்க, அடுத்த வருஷம் பண்ற லாஸ் actually குறைஞ்சிருக்கு, which means that they are becoming a profit, they would soon become a profit making entity. So we were the management consultant for this entity, which is an Ind AS entity. There was an auditor in the other side of the table, where we were evaluating whether we have to create deferred tax or not. So let us put a cumulative losses. So cumulatively, the company has 420, let us say all these numbers are in lakhs, 420 lakhs of losses, and they have 320 lakhs of depreciation loss. First, we'll ignore the depreciation loss. We'll just first bother about book loss, because there is a validity period for that. Now, the first question before I start evaluating whether I will create deferred tax asset or not is very simple. Now, this year they made profit. Next year, I will look at a company's projection. Projection is not the standpoint for virtual certainty, but it is a starting point to establish the virtual certainty. Now, this entity, I look at how many orders they have. If this order, because this company is having an establishment of last 6 years. So I look at how many orders that they have, order backlog that this entity has. Order backlogs with the recurring customers. இது வரைக்கும் சர்வீஸ் பண்ண கஸ்டமர்ஸ் கிட்ட எவ்வளவு ஆர்டர் பேக்லாக் இருக்கு, அவங்க கிட்ட POs இருக்கு, where these are from an existing customer, new customer, fresh customer, which I have not seen whether they will do business or not இல்லாம existing customers ல எவ்வளவு order backlog இருக்கு. So that comprises of, let us say, 70% of their projected turnover னு வெச்சுக்கோங்க. இப்போ 2023 I will ask for the business projection 2023 2024. இப்போ realistically they are saying that they will have a projection, they will start making profits in 2023 also. Let us say they will be making losses. 2024 where they say they will start becoming profit at 20. First year 2024 they will start making profit. I make all the losses as negative. So in this year also they will only make losses, and first year in 2024 they will make a profit of 20 rupees they will make. 2025 also they will start making profit as per their projection. They say that they will make a profit of around 50. Now my cumulative losses till 2022 is 420. So இது வரைக்கும் actuals இதுல இருந்து projections. அப்போ என்னோட லாஸ் எவ்வளவு ஆகும்? I have a loss of 430. Okay, now 2017 loss 8 வருஷம் இருக்கு. So which means that I can absorb 2017 ல incur பண்ண loss maximum by 2024. Correct? It's a first in first out concept. So I believe that there is a virtual certainty that they will make these profits. 20 rupees profit பண்ணுவாங்க or 50 profit பண்ணுவாங்கன்னு வெச்சுக்கோங்க. Virtual certainty இருக்கு அப்படிங்கிற example, because I have seen their order backlogs. I have seen that there is a supply that is going on, and some of the orders are from recurring customers where in the past also they have done something. Virtual certainty is a subjectual item. அதுக்கு ஒரு ரூல் ஆஃப் தம் கிடையாது. இது virtual certainty இருக்கு, இது virtual certainty இல்ல அப்படின்னு எஸ்டாப்ளிஷ் பண்ணுறதுக்கு. பட் POs are not the point of virtual certainty establishment, which standard is very clear. But we have to start with POs. We have to understand who's this POs from, whether they have regular business with those entities, and what are the initiatives the companies is taking in the projections. All that will be evaluated. Literally, you will have a gut feel. You will have to establish whether the company will make these profits or not, or the company is not making profit. That is something that you can easily, by the auditor has the inherent skills to determine that. So you will easily determine that. So now what happens is, now I know that out of this 100, the max they're going to absorb is only 50, even if they make profit. I am saying there's a virtual certainty. So now I know their losses are coming down, so I have to create a deferred tax asset. I will not create a deferred tax asset till 2020 or 21, because every year I evaluate. I don't know whether there is a virtual certainty that they will start making profits. In 2023, I know that their losses have completely come down, or even in the minimum profit. It need not be a minimum profit, even it could be there is a continuous pattern except for the year of COVID that their losses are coming down. So there is a possibility, it will turn around to a profit making company. There is a evident profitable point here. So either path I can say, okay, there is a probability that this company might make a profitability. So there is a virtual certainty established. In the scenario, if I am going to evaluate deferred taxes, I will not create deferred tax asset for the entire value. First, I should create deferred tax asset only to the tune. First, unless and until I have a virtual certainty, I will not touch deferred tax asset. So now I know that there is a virtual certainty involved, and I am going to create a deferred tax asset. To what value? The standard says, to whatever extent you believe, or whatever extent that there will be a reversal of deferred tax asset in the future, you have to create only to that extent. So how do you determine that extent? This is how we want to determine it. Now, as per their profit, as per their statement itself, in the first year loss, they can absorb only 50. So what I will do is, I will create deferred tax asset. Now, their total losses is 425. Out of that, in the near future, I know that they are going to have only 50, even if their projections are going to be right, 50 plus 60, right? Because I cannot predict beyond 3 years. Very difficult. I will create deferred taxes only this tune. While I will have losses for 425, I only create only to this tune. I will not create for the entire asset. So this is the overall losses that they have. So now deferred tax asset create pannona 85 create pannikano ideally, but I will create only to the tune of 22 because I know that I can establish from today's on basis of all the assumptions and data that is available with me. I can only establish that there will be a reversal to the tune of 110. It's not, we are not saying that they can reverse only 110. They might reverse more also. But based on what is available with us on deferred tax asset, I'll be prudent and create deferred tax asset only to the tune where I see an establishment of reversal. Clear here? Deferred tax asset should be recognized only to the extent there is a virtual certainty supported by collecting convincing evidence of their realizations. So here, deferred tax asset should be recognized and carry forward only to the extent there is a reasonable certainty that sufficient future taxable income will be available against which they can be realized. If that is not the case, as a carry forward unabsorbed it can carry forward the losses forever. You will create a deferred tax asset only when you see that there is a virtual certainty. Amount might vary. That's a different story. On depreciation loss, I might create for the whole amount because there is no utility period for that. But I will make a prudence here on that aspect as well. Clear? So global standards are talking about reasonable certainty for deferred tax asset creation. The Indian standard base 22 is talking about virtual certainty. So how could you examine reasonable certainty, past records of the enterprise, estimates, making realistic estimates, projections and etc. where there is a realistic estimate. So here we cannot, virtual certainty is not merely measured by forecast and performance. It is to be evidenced. So the evidence is what I told you. So they make a forecast, but they say that they will take 10 new customers on board. That is what is there in their forecast. But you know that in the past 5 years, they have not, their new customers ratio is 20% every year. And now they are saying that they will bring 10 new customers. It doesn't look that certain. So, and this virtual certainty is a subjective matter. It's a matter of judgment. And I know that when you have an experience with the client, you can make that judgment much better than what is given in the standard. You will know, literally by knowing that particular estimate, you will make a better judgment to know whether this is prudent enough to create or not prudent enough to create. Okay. So now we have another question where this 425 minus 110 is 315. This 315 is nothing but is the deferred tax asset that is unrecognized. In global parlance, it's called valuation allowance. So when you put a deferred tax reco, we call this as valuation allowance and say that 315, there is no deferred tax created. So what the standard says is you evaluate this 315 every year. So unrecognized deferred tax asset should be reassessed at every balance sheet, and if it is reasonable, then in the subsequent year you might create deferred tax asset for the a portion or full value of the unrecognized deferred tax asset portions. It depends again on the case whether there is a requirement or there is no requirement. But the standard says you have to evaluate it. So in the year 1 and I am in 2023. I'll go to 2024 and still evaluate whether there is a probability that they are in a position to absorb more taxes. So my unrecognized portion as on 2022, let us say, is around 315. And in 2023, actually they ended up by, let us say, by making a profit in this current year, which is around 15. They made a profit. My unrecognized is 295. So there could be a scenario where I might have to create a deferred tax for the entire 295 because I feel that, okay, 2023, they have absorbed certain losses. They might increase the projections, etc. So something like that. So what the crux of the matter here is, we should evaluate that you will have to create more taxes or the unrecognized deferred tax balances can be carried off as such or not. Clear till now? Clear till now? Any questions, any thoughts? Okay, so I will continue further. I think we have discussed this part. Okay, now as we said that we have to review unrecognized deferred tax asset, we have to review the deferred tax balances as well, because there are two parts to the curve. So here, out of 405, we are saying 295 is unrecognized, so which have to be evaluated. So there is another point here, 110, which also have to be evaluated. I should check whether I will be in a position to absorb this 110 or not. If this 110 is more, I have created a deferred tax asset for a more value, then I might have to reverse that also. In the sense, we have to be very prudent on one thing, that whether whatever deferred tax asset that we are carrying at the end of the balance sheet, whether it will get reversed in the future, whether there will be a realization that will happen in the future. Every year, when we are doing a audit or when we are finalizing, we might have to evaluate this particular concept. Clear here? So you will have to evaluate whether 295 is right, you have to evaluate whether 110 is right, and etc. Okay, so we have talked about offset. I'll just take there is one couple of more concepts that we have to discuss on deferred taxes with respect to MAT and with respect to tax holidays and etc. and the what rate has to be used in aspects. But before that, I will take certain practical elements here on how we compute deferred taxes and what are the best practices and etc. I want this to be a little bit interactive, if not for the other part of the session. இப்போ இந்த எக்ஸாம்பிளே எடுத்துப்போம். Or I'll just keep it here. Most of the scenarios, whenever I review certain balance sheets, I do a peer review of certain balance sheets of listed entities and non-listed entities in the for the firms that I know in the future. There are certain errors that we see commonly. One error that we see is reversals where original asset or liability is not created. Very classic example is something like this. Let us take this element. Last year 40 IA plus last year 43B disallowance. When I say last, I mean last year 43B disallowance. There will be leave encashments and etc. I'm not going to that now. So either at the point. So either over 10, let us say either over 15. His own timing. So this on the DTL. DTL is actually DTA over a reversal, which is a DTL. Correct? Ipo, most often or more often or not, what happens is, when we create deferred tax asset, ipo in the 39.1625 create பண்ணுவாங்க. Ideally 39.1625 create பண்ணிடுவாங்க. Timing differences இதெல்லாம் இருக்குன்னு evaluate பண்ணிட்டு அதுக்கு create பண்ணிடுவாங்க. Sorry. So okay, DTL ஓட reversal correct ஆ இருக்கும். DTL இங்க இருக்கிற எல்லா வேல்யூக்கும் கிரியேட் பண்ணிடுவாங்க. அதாவது what happens is I will create a deferred tax asset. I'll just look at what are the DTAs that I have. This is negative, so I have a DTA. This and this are positive, so I have a DTL. DTA is negative, DTL is positive. And again, I have a DTL here, so it means I should put a negative symbol. And here I have a DTA. Correct? So 40.83 is my position. Invariably, more often than not, what people do is, this is actually not a deferred tax liability, but a reversal of a deferred tax asset that is created, that originally or ought to have been created in the previous period. Correct? But enna aguna, ipo indha varsham nama statement of income or management of income computation podrom. Pota vadane we compute all these items and say, okay, nama deferred tax liability asset yo nama compute பண்ணிடலாம் அப்படினு போடுறோம். ஆனா என்ன ஆகும் அப்படின்னா, இந்த 25 ரூபாய்க்கு போன வருஷம் deferred tax asset create பண்ணியிருந்தா மட்டும்தான் நான் இந்த வருஷம் ரிவர்ஸ் பண்ணணும். பிகாஸ் இது என்ன, லாஸ்ட் இயரோட 40 ஐயும் லாஸ்ட் இயரோட 43 பியும் நான் டிஸ்அலோவ் பண்ணதுனால ஐ வுட் ஹவ் கிரியேட்டட் a deferred tax asset. இந்த வருஷம் இதை ஆக்சுவலா அலோவ் பண்றேன், அதனால ஐ எம் ரிவர்சிங் இட். இந்த எக்ஸாம்பிள் மாதிரி இந்த வருஷம் 45 கிரியேட் பண்ணிருக்கேன், இந்த வருஷம் 45 கிரியேட் பண்ணிருப்பேன், இந்த வருஷம் 20க்கு அப்படியே இன்னொன்னு கிரியேட் பண்ணிருப்பேன், இந்த வருஷம் 4க்கு கிரியேட் பண்ணிருப்பேன். Subsequently 5.78 out of that I am reversing. This is the concept here. So cumulative பார்த்தா இங்க 64க்கு தான் நான் கேரி பண்ணணும், இங்க 51க்கு தான் நான் கேரி பண்ணணும். This is the concept, right? But invariably என்ன ஆகும், நாம இந்த வருஷம் SOI போடுறோம், இல்ல போன வருஷம் ஆடிட் மாறி இருக்கு, ஆர் போன வருஷம் பண்ண ஆர்டிகல் அசிஸ்டன்ட் விட்டுட்டாரு, அதை கம்ப்யூட் பண்ணல, மிஸ் பண்ணிட்டாரு அப்படின்னா டு என்ன சொல்றது, டு மேக் அ மிஸ்டேக் ரைட், இந்த மாதிரி கிரியேட் பண்ணும்போது we are doing it double mistake. That is, invariably we are increasing the deferred tax liability. It is not the case. It actually ideally என்ன போன வருஷம் to the same extent I should have had a deferred tax asset. அது 0 ஆகிறதுக்கு I am creating 25 here. இதான் correct value. So I will show you something. இந்த மாதிரி நான் whenever I create deferred tax assets, நான் வந்து ஒரு பல்கா பேலன்ஸா எடுத்துட்டு போயிட்டு வைக்கவே மாட்டேன். That is a good practice is we should not say more even than not என்ன பண்றோம் அப்படின்னா, let us say இந்த பர்டிகுலர் எக்ஸாம்பிள்ல இந்த 2025 இல்லைன்னு வச்சுக்கோங்க, நம்ம என்ன பண்ணிருப்போம் 15.83 into 20%, இது வந்து 3.17. ஸோ இது என்ன ஆகும்னா, நம்மளோட ஃபினான்ஷியல் ஸ்டேட்மெண்ட்ல நம்ம எங்கெல்லாம் காட்டுறோமோ என்ன பண்ணுவோம்னா, ஓப்பனிங் deferred tax plus created in the current year, closing deferred tax. So opening 0 னு வெச்சுப்போம், 3.17 is a deferred tax asset that I am creating. So my closing deferred tax asset is 3.17. next yearல நான் என்ன பண்ணுவோம், இத ஓபனிங் ஆக்கிட்டு கரண்ட் இயர்ல என்ன இம்பாக்ட்ஸ்னு பார்ப்போம். அப்போ மோர் ஆஃபன் than not what will happen is இந்த 3.17 எதனால கிரியேட் ஆச்சு அப்படிங்கிற இம்பாக்ட் லாஸ்ட் இயரோட ஆடிட் ஃபைல போய் ரிவ்யூ பண்ணாதான் தெரியும், ஆர் லாஸ்ட் இயரோட கம்ப்யூட்டேஷனை ரீவொர்க் பண்ணி பார்த்தா தான் தெரியும். ஸோ unless and until we are sure that last year deferred tax has been created for reversal items, I mean you need to check. இப்போ இதெல்லாம் ரிவர்சல், இந்த ரெண்டும் ரிவர்சல் ஐட்டம்ஸ், இது ரெண்டும் ரிவர்சல் ஐட்டம்ஸ் இல்லையா? இந்த ரிவர்சல் ஐட்டம்ஸ் எல்லாம் லாஸ்ட் இயர் deferred tax asset கிரியேட் பண்ணிருக்காங்களா இல்லையான்னு ஒரு வாட்டி இவாலுவேட் பண்ணிட்டு தான் we should reverse it in fresh. This is something that more often than not happens. லாஸ்ட் இயர் அதுக்கு deferred tax asset liability பே பண்ணாம இந்த வருஷம் நம்ம சப்சிக்வெண்டா போய் ரிவர்ஸ் பண்ணுவோம், which is ஒரு தப்ப சரி பண்ணுறதுக்கு நம்ம டபுள் தப்பு பண்ற மாதிரி ஆயிடும். ஸோ we need to be very cautious on that. இதை எப்படி அவாய்ட் பண்ணுறது, இந்த மிஸ்டேக் எப்படி நம்ம ஈவன் அவுட் பண்ணுறது அப்படின்னா, that is the reason why I generally create a reco lines. இது வந்து இண்டேஸ்க்காக நம்ம பண்ணியிருக்கோம். பட் irrespective of this fact, the best practice is to create a file like this. இப்போ இங்க போனீங்கன்னா இந்த கமெண்ட்ல இருக்கும், இந்த ஃபினான்ஷியல் அசெட் ஆன் அமார்டைஸ் காஸ்ட், லீவ் தட் ஃபார் அ மொமெண்ட், the terminologies விட்டுருங்க. இப்போ இது வந்து ஓகே, ஐ சேஞ்ச் த terminologies. ப்ராப்பர்ட்டி பிளான்ட் அண்ட் எக்யூப்மெண்ட் அப்படிங்கிறது கிரியேட்டட் ஆன் அக்கவுண்ட் ஆஃப் ஃபிக்ஸ்ட் அசெட்ஸ். Okay, the current standard is also provided in an agreement. Okay, this is on account of leases. So this is on account of leave encashments, gratuity, and etc. This is on account of taxes. This is on account of provision for income tax, because provision is not allowed in income tax, only bad debts are allowed in income tax, created on account of provisions. Ipo what I generally do is I create a comment here. So this is on account of these lease impact, enna standard oda enna idoda impact in the other assets, income tax disallowance on deferred tax asset, disallowance is enna vandirukku adanal create pannudhu. This 13 ka illa separate working or separate file attached to same sheet. And provision for bad and disable debts ku enna pannirvom appdinu. Financial liability, bank loan or deferred tax, there is a concept on in IFRS that you have to amortize bank loan. On account of this we have created this deferred tax. Leave the that part because that's not part of the topic, but the substance here is we should not carry it as a bucket. We should carry it under different category, or we should carry a working. It is up to us whether we represent, because the standard is, when we see what is the allowance that the standard has to be says, the standard says that it should be disclosed. Major component is to be disclosed in the notes on accounts. Major components அப்படிங்கிறச்சு இதான் தான் மேஜர் காம்பனன்ட்ஸ். இது ஆல்ரெடி ஸ்டாண்டர்ட்ல இருக்கிறது தான், பட் இன் பை அண்ட் லார்ஜ் இட்ஸ் நாட் ஃபாலோ. I mean most of the balance sheets I don't see this being practiced. But the standard says we need to put the component there. But what happens is people put the component, but component only the current year charge they put. So இப்போ என்ன ஆகும்னா இந்த இயர் இருக்குல்ல, இந்த இயர்ல நான் போயிட்டு நான் என்ன பண்ணுவேன்னா இந்த 13.15 இதுல எவ்வளவு ஃபிக்ஸட் அசெட்ஸ்னால வருது, எவ்வளவு வந்து இப்போ ஓப்பனிங்ல எனக்கு ஒரு 4 ரூபாய் இருந்ததுன்னு வச்சுக்கோங்க, 5 ரூபாய் இருந்ததுன்னா ஃபிக்ஸட் அசெட்ஸ்னால எவ்வளவு வருது, இன்கம் டாக்ஸ் டிஸ்அலவன்சஸ்னால எவ்வளவு வருது, வாட் எல்ஸ் வாஸ் தேர், லீசஸ்னால எவ்வளவு வருது அப்படின்னு நான் இங்க கேட்டகரைஸ் பண்ணி கரண்ட் இயர் இம்பாக்ட் ஆஃப் 3.17 ஐ வில் டிஸ்டிங்விஷ். ஸோ இது ரெண்டுனால வர இம்பாக்ட் 25. By and large, balance sheets carry this value, this difference. In the மாதிரி major components disclose பண்றாங்க. But we don't carry what happened to this 4. அது யாருக்கும் தெரியாது. So I mean, what are the components of this 4 அப்படிங்கிறது தெரியாது. இதுவும் கண்டினியூஸா வந்துட்டு இருக்கும்ல. So இப்போ ஃபர்ஸ்ட் இயர், செகண்ட் இயர், தேர்ட் இயர்னா ஓகே. பட் லெட் அஸ் சே ஒரு கம்பெனியோட பேலன்ஸ் ஷீட் நம்ம 6 வருஷமா பண்ணிட்டு இருக்கோம் அப்படின்னா 6வது வருஷம் ஆரம்பத்துல ஓப்பனிங் டெஃபர்ட் டாக்ஸ் ஒரு நம்பர் இருக்கும். இந்த ஓப்பனிங் டெஃபர்ட் டாக்ஸோட நம்பர் போன வருஷம் கிரியேட் பண்ண அசெட்னால வருதா, இந்த வருஷம் கிரியேட் பண்ண அசெட்னால வருதானே தெரியாது. So what happens is 1 year we have to take that as a exercise and try to evaluate ஒரு 5 வருஷ பேலன்ஸ் ஷீட். It will not be by and large beyond 4-5 years of your balance sheets if a company is for a long time. எதனால நம்ம ஈச் இயர் டெஃபர்ட் டாக்ஸ் அசெட்ஸ் கிரியேட் பண்ணிருக்கோம், ஒரு ஆர்டிகல் அசிஸ்டன்ட் போட்டு லாஸ்ட் 5 இயர்ஸ்னோட நம்பர்ஸ் நம்ம டெப்ளாய் பண்ணி அதோட டோட்டல் போட்டு குமுலேட்டிவ் க்ளோசிங் பேலன்சஸ், இந்த 4 ரூபாயோட பிரேக்கப், இந்த 4 ரூபாயில எவ்வளவு ஃபிக்ஸட்ஸ்னால கிரியேட் ஆச்சு, 4 ரூபாயில எவ்வளவு டிஸ்அலவன்சஸ்னால கிரியேட் ஆச்சு, 4 ரூபாயில எவ்வளவு லீசஸ்னால கிரியேட் ஆச்சு அப்படின்னு நம்ம ஒரு ரெக்கார்ட் வச்சுக்கோம்னா இப்போ இந்த மாதிரி, அதாவது டெஃபர்ட் டாக்ஸ் அசெட்டே லாஸ்ட் டைம் கிரியேட் பண்ணாம இப்ப நம்ம ரிவர்ஸ் பண்றோம் அப்படின்ற சினாரியோ வராது. So this is something that I see commonly in deferred tax computation across balance sheets. So just a word of caution, I thought I'll keep it done, because you should not reverse a deferred tax that's not originally created. It is meaningless. So that is one point. Second, let us take this example. Let's take this example. You can create deferred taxes on this number. You can create deferred taxes on WDV itself, on the differences between WDV. Land illama irukkom, so I can create deferred taxes on this aspect as well. Okay, so just a moment. So let us take this as an example. Sorry, not got stuck. So here I can create on WDV, I can create on depreciation. So this is called income approach. This is called asset approach. But the point is, when you are creating using income approach, what will happen is we are finding out what should be the charge in the current year. When we are doing an asset approach, what we are calculating is what should be my closing balance. So it will always be the difference. So for example, I'll do in both. Let us assume that tax rate is at 20%. So what would happen is, if I'm using income approach, assuming for a moment there is no other standard, closing will be, next year closing will be like this. If you're using a WDV approach, which is the closing balance itself, something that we compute, it will be like this. So first year it will be invariably the same. So actually what you're computing is, inga vandu nama vera endha complication edukadanaala income approach oda impact asset approach oda impact more or less same ah dhaan varum. But in certain entities or in most of the scenarios, what would happen is the flip there could be certain assets that are sold, there are assets that would be bought, there will be certain impacts like that. Because of that, you will not get the same value across all the years. Asset approach, income approach. This is income approach, this is asset approach. In asset approach, you find out the closing balance and you subtract the closing balance from the opening balance. In an income approach, you just add what is the current year ka charge. Now, one important element here is what approach you feel is more appropriate. Is it income approach or the asset approach? The current accounting standard on AS 22 allows both approaches. The standard is not saying you should only do this, but what do you think could be a better approach, income approach or an asset approach? Any thoughts? Income approach la pannadhu better nu nenikreenga illa asset approach la pannadhu you feel it is better? Any view, it could be anything. You can say what you feel comfortable. So it's not like, because the standard is allowing both approaches, we will not be wrong in choosing one of those approaches, right? So what do you think is the right approach? Any thoughts? You can be free to tell me what is the approach that you would suggest.
Income approach should be easy to compute now, sir.
Okay, income approach. So there are okay. So income approach is what a few suggest. One or two suggest. And is there any other person who feels that we should use asset approach instead of income approach? Am I audible? So anyone feels that no, income approach is not a viable one. We should use asset approach. Okay, so now I'll tell you what is something that I follow. I leave it for the listeners to choose among those aspects. I am going to discuss the point I am making is the approach that I follow. So generally, the IFRS standards and India standards doesn't prescribe income approach. The standard is very clear that it should be calculated on asset approach. So asset approach is one thing that is being prescribed and followed by the international standard. India and IFRS follows international approach, follows the asset approach. It doesn't follow the current approach, which the income approach. Why? So I have explanation for both the schools, but I generally prescribe an asset approach because of two things. When you read the literature of the standard on deferred tax asset, everywhere the standard talks about, if you see the conceptual framework of the standard, it talks about what should be the closing balance of deferred tax asset. Carrying value of the deferred tax asset has to be checked for prudence, whether this will get reversed in the future. So it always talks about the asset balance primarily, and it is focusing less on the current year ka levy or current year ka charge or current year ka benefit, right? So standard enga paathalum deferred tax asset or liability, closing balance pathiye da entry charge pannu. Because deferred tax asset or liability is something that you create at the balance sheet level, which you are going to evaluate whether it is going to be absorbed in the subsequent year or not. An ideal approach is to look at the WDV level, the asset levels, and compute the difference between those two and evaluate and determine the difference between these two standards. So one reason why I suggest asset approaches, one is the international accounting standards. Second is the standard is always imposing about the asset rather than the current year levy. So computing the closing balance and arriving at what should be the opening as a subset of it would be a more meaningful approach. So that is the reason why I prescribe asset approach as one. Second very important reason is, let us take ஒரு example எடுத்துப்போம். 100 is the asset opening balance. Let's say this year we have made an addition of 20, and assuming for a most simplistic note, it has been added in the first year of the balance sheet, and there is there is an opening gear and opening gross block, addition of 10, and there is a deletion in the gross block of -10. So closing balance is X. So opening accumulated depreciation, let us say, is around 50. Current year charge is 10, and you are subtracting somewhere around 9 because the balance is cash reserve or something like that. So you are subtracting the 9 because 10 rupees are in the depreciation. So 9 is the deletion value, and we are having a closing like this. So net block is 210. So if in the asset pathona gross block in the sale on asset or gross block or deletion pathina accumulated depreciation debit. Gross block is debited to the tune of 10, and let us say the payment from bank was 2. Then the gain will be, so these are getting debited, this is getting debited, this is getting credited, it will be 1. Zero. Now, when I am going to put the same for the Income Tax Act, I will only carry it at a net block. So I'm just assuming for a moment my net block was, opening net block 150. So which means that I want to have an presumption that my depreciation as per Companies Act was more than what was there, less than what was there in the Income Tax Act. So I'll assume my net block, opening net block as per, this is as per Companies Act, this is as per Income Tax Act. So my net block which I had for opening itself is 120. Income Tax Act net block opening opening. So we won't segregate. So now if in the addition should match anyway. So addition should match to 20. And when it comes to deletion or removal from the block, I'm not going to delete 10. I will only delete 2, correct? Because I will remove the block only to the balance that I have received. The money that I have received from the sale. So this will be my close. Okay, I'll add the depreciation part. Current year depreciation was somewhere around opening. Okay, this is current year, right? Current year was 10. So I'll assume current year is 15 here. So 123 is my block. Now, if I compute depreciation purely on account of my income approach, my balance will be 5. This is not encompassing that this asset is removed only at 2 rupees here, but the asset here is removed at 1. Correct? Netta பார்த்தா 1 ரூபாய் தான் ரெடியூஸ் ஆயிருக்கு பிளாக்ல இருந்து. கரெக்ட்டா? 1 ரூபாய் தான் ரெடியூஸ் ஆயிருக்கு பிளாக்ல இருந்து. In the fact of 1 and 2 removal will never get recorded in my asset computation, in deferred tax computation. So one argument is இது partial delete ஆயிருக்குனா நான் எப்படியும் இங்க depreciation கன்சிடர் பண்ணிடுறேன். இந்த depreciationல இது எப்படியும் closing block subtract பண்ணி தான் கன்சிடர் பண்றேன். Correct? But the impact of 1 rupee that is getting reduced in the WDV itself is not recognized anywhere. Right? You have a part of the depreciation that you charge. So there could be a lot of permutations. Like the first day remove acha, second day remove acha, 6 months kapro reduce acha, 6 months munadi. All those permutations will impact my current year depreciation. So if I do it on current year depreciation, I am not recording certain, I am not giving effect to the entire deletion to the entirety. While a part of it is considered because of the depreciation, I am not considering the entirety. So one better approach to line with the international standard and ensuring that all the asset components are getting considered is using a asset approach. So asset approach la panna enakku 261 36 la compute பண்ணுவேன் closing balance. My opening balance would have been 30. So ideally, என்னோட இம்பாக்ட் இங்க பாத்தீங்கன்னா 6 rupeesல கிரியேட் ஆகுது, பட் இங்க 5 rupeesல தான் கிரியேட் ஆகுது. இந்த 1 rupee is nothing but the asset deletion. That is the reason why it's not getting created. Clear here? So I, as a practice, follow asset method or a WDV method, not income approach. So is it not? It is not difficult to shift also. If you intend to shift, it's not like income approach is wrong. Because I believe that international standards are approach. My personal opinion is I prescribe asset approach. In AS22, both are allowed. So when you come to asset approach, you can do the asset approach in 1 year. The levy will be a little higher because you are changing from income approach to asset approach. In 1 year, there will be a little bit of an extra levy, or there could be a reversal. It depends on what is the balance that you are creating, what is the balance that you are carrying. So we cannot comment on it specifically. But it is not impossible to change from the asset approach to income approach or income approach to asset approach. So this is here. And next is on, okay. So there are certain discussions. I just have 10-15 minutes of time. So what are the items that has to be dealt? Okay, what is the rate that has to be used for creating deferred tax? So current tax is about what are the laws that has enacted and what is applicable for the current year, because deferred tax asset is on the future reversals. Because if we asset create pandromo, liability create pandromo, it will be future reverse ahumra concept. So always we should consider even tax rate that are announced but not yet applicable for the entity. Budget revise rate on the, but on the rate in the year applicable, assessment year applicable, future rate deferred taxes create. It is enacted or substantively enacted rate. That's what is the wording that's used in the standard. But this is only enacted rates. It is to be applicable in the version in the assessment year applicable. Other than our tax rate applied. But deferred tax rates enacted or substantively enacted on the rate we should create deferred taxes, because deferred taxes are already at for the future profits. There is no present value of deferred taxes at all. So this is on certain fundamental concepts. Last point is on tax holiday periods. How do you do deferred taxes on tax holiday period? So I'll discuss that and close the session and keep it open for certain questions if you have any. So what we discussed, just to summarize whatever we have discussed: why deferred tax, how deferred tax is computed in terms of your assets and liabilities, what is the difference in timing, what is the difference in permanent, what rate you would adopt for the tax deferred tax creation. For timing, you will apply deferred tax and create an asset or a liability. When it comes to permanent, you will just make it part of a record to know that, okay, my computation is right, I have not missed anything on the deferred tax for that, and also to show that your the tax rate are normalized. To establish that, we put a record. The next point is on what are the prudence concept that you have to apply for deferred tax asset. How do you create deferred tax asset on losses, and to what extent we have to create for losses? What is virtual certainty? And we discussed about certain common elements or mistakes or whatever that we could that we have seen in deferred taxes. And when it comes to depreciation, the asset approach versus income approach, what is preferable, what is not preferable. So this is what we've discussed so far. The last point is on tax holiday period. So this is very unique because or a period, tax holiday periods, right? There is no taxation. You don't have a taxation element at all. On the periods, do we have to create deferred taxes or not? That is the first question that is in front of us. If normally deferred tax asset or liability create pannom, ஏன்னா accounting profit kum taxable profit kum differences irukku. But tax holiday period I am not going to be subject to any tax, ATIA, AT, whatever. During those scenarios, how do I assess for deferred taxes? That is a question in front of us. So standard, what the standard is saying is, if there is a deferred tax that gets originated in the period, in the start of the tax holiday period, which gets reversed during the tax holiday period itself, don't recognize deferred taxes to that value. If it reverses after the tax holiday period, recognize deferred tax in the year in which timing difference originally originated. Standard order timing differences which reverse during the tax holiday period do not recognize deferred taxes. Timing differences which reverse after the tax holiday period recognize deferred taxes. So in the statute என்ன சொல்ல வர்றது அப்படின்னா, so this is something that I did. The numbers are not original. So what standard is asking you to do? Timing difference that will reverse during the tax holiday period. அப்படின்னா என்ன அர்த்தம்? இப்போ நான் வந்து let us say I have year 1, year 2. நம்ம இந்த எக்ஸாம்பிள் எடுத்துப்போம். First example, the example that we took for depreciation. Yeah, let us take this example. இப்போ இதுல first year there is a timing difference that is created, which is 45 minus 45. Second year, the timing difference that is created is 65, which means that this 45 is becoming 65. Correct? 45 cumulative நம்ம பார்க்கிறோம். So 45 is becoming 65. Timing difference reverse ஆகுதா ஆல? ஏன்னா minus 45 இருந்தது, minus 65 ஆயிடுச்சு. அப்போ timing difference increase தான் இருக்கு, reverse ஆல. Let me make it green. Subsequent period 70. அப்போ என்ன ஆகுது? அப்பையும் டைமிங் டிஃபரன்ஸ் ரிவர்ஸ் ஆகல. 45 நெகட்டிவ்ல இருந்தது, செகண்ட் இயரும் நெகட்டிவ் 65ல இருக்கு, தேர்ட் இயரும் மைனஸ் 70ல இருக்கு. அப்படின்னா 3 இயரும் இது ரிவர்ஸே ஆகல. டைமிங் டிஃபரன்ஸ் ரிவர்ஸ் ஆகுதுன்னா என்ன ஆகும்? நம்ம ஆரம்பிக்கிறது நெகட்டிவ் சைன்ல ஆரம்பிக்கிறோம். அப்ப ஏதாவது ஒரு பீரியட்ல இந்த நெகட்டிவ் சைன் குறையணும் ஆர் நெகட்டிவ் சைன் பாசிட்டிவ் ஆகணும். அப்பதான் அது ரிவர்ஸ் ஆகுதுன்னு அர்த்தம். கரெக்டா? இப்போ சப்சிக்வெண்ட் இயர் பார்ப்போம். குமுலேட்டிவ் தானே பார்க்குறோம், ஏன்னா இது அசெட் அப்ரோச். 64 ஆகுது, பட் இது ரிவர்ஸ் ஆகுதான்னா 70 64 ஆயிருக்கே தவிச்சு 45 விட இது கம்மியா இல்ல. This is not less than 45. So here also it is not reversing. 45 விட அதிகமா தானே இருக்கு. It has started to reverse, but it is not reversing this 45 impact. Correct? Where it is originally reversing is அடுத்த இயரும் 51 45 விட அதிகம் தான். It is not reversing. Only in the 6th year this is getting reversed. Only in the 6th year it is getting reversed. Correct? ஏன்னா 6th year minus 45 minus 34 ஆயிடுச்சு. So there is a reversal. Standard என்ன சொல்லுதுன்னா tax holiday period இருக்கு. So நான் வந்து 31st March 2018 இதை கம்ப்யூட் பண்றேன்னு வச்சுக்கோங்க. ஒரு 4 யூனிட் இருக்கு, அதுக்கு நான் கிரியேட் பண்றேன். இது எல்லாத்துக்கும் என்கிட்ட tax holiday period 80IA deductions claim பண்றேன். In the particular asset is eligible for 22. This is an example that created long back and is continuing with it. 22, 19, 24, 23, 28. Okay. So what is the position here? First, எல்லா பீரியட்லயுமே எனக்கு DTL தான் வந்திருக்கு, which is 8.34, 59, 8 crore, 59 lakhs. Then next is 4.67 crores. Tax holidays individual branches இருக்கிறதுனால நான் இண்டிவிஜுவலா எடுக்கிறேன். 33 lakhs and 1.16 crores. This is my deferred tax asset or a position. That is, whether it could be positive or a negative position, this is a liability position for me. I have to evaluate whether it will get reversed in the future after the tax holiday period. Tax holiday period 22 la முடியும். So 22 க்கு நான் என்ன பண்ணனும்னா நான் வந்து என்னோட பேலன்ஸ் ஷீட்டை எக்ஸ்ட்ராபுலேட் பண்ணனும். எப்படி எக்ஸ்ட்ராபுலேட் பண்ணனும்? Assuming for a moment there is no other addition. இப்போ நான் வந்து 2018ல இருக்கேன். 19, 20, 21, 22 4 வருஷமும் ஒரு அசெட்டும் ஆட் ஆகலன்னு வச்சுக்கோங்க. அசெட்டே ஆட் ஆகாத பட்சத்துல there are no other asset additions, what would be my WDV? What would be my company's activity? There will only be depreciation. It will be computed for 365 days. I will assume there is no deletion. Status quo. இப்போ இருக்கிற asset positionல I will have neither deletion nor addition. Only thing that I will have depreciation charge. And the scenario what would be my company's act WDV? The same way, what would be my IT Act WDV? So I had 10 crores. What would become my IT Act WDV? It will be 7.27. When I see these two, now I will not compute this forever. My tax holiday period is ending in 22. So I will start with my current year, which is 18, because that is a year for which I'm going to evaluate whether for tax holiday period I have to create deferred tax asset or not. This is getting subsequently reversed or not is something that I will check. Now 8.34 is there. This has become 9.14. Is this reversing? No. There is a DTL. The DTL is only getting increased. So it is not getting reversed. So I will create deferred tax only to the tune of this value. What the standard is saying, if there is a reversal, To the tune of reversal, don't create deferred tax. To the tune of reversal, don't create deferred tax. So here it is not getting reversed. So I'll create deferred tax only to this tune. Just for an assumption. Let us say that I'm going to make this as 754,121. 7 crore. Here I have a DTA of 8 crores. During the tax holiday period, I mean at the end of the tax holiday period, ideally, there is a reversal. Only if there is a reversal during the tax holiday period, at the end of the tax holiday period, the value will be less. Because this value is less, the standard says what? Don't create deferred tax asset to the extent of reversal. For the reversal, I should not create. So my deferred tax will not be 116. It will be on this 7.12. Getting this difference? Getting this concept? இப்போ அந்த ஸ்டாண்டர்ட் என்ன சொல்லிருக்குங்கற திருப்பி படிப்போம். Timing differences which reverse. இப்போ இந்த இடத்துல timing differences which reverses 122. So I will not create deferred tax to the tune of 122, which is nothing but this value. Timing differences which get reversed, no deferred tax. Timing differences, if not getting reversed, timing differences which reverse during the tax holiday period, no deferred tax. So this value I will not create deferred tax. If timing difference is not going to be reversed, like our original example, I will create deferred tax to the tune of this original value, which is not 1.82, to the tune of 1.66. Clear here? What we have to do on tax holidays. So every year, what I will do is during the period of tax holiday, if I 2018, 19, I would have redone this 20. So 19, I will take 19 WDV as per Companies Act and Income Tax Act. I will extrapolate that for end of the tax holiday period, which is assessment year 21-22. Keeping that as a base, I will check whether what is the DTA position, what is the extrapolated DTA position, whether it is reversed or whether it is same. All that I will evaluate. Clear? So thank you, friends. So with this, I'll take you. So what are the aspects that we discussed is on disclosure part. So that I think we have just skimmed through. I'll just take that portion alone. So what are the items that has to be disclosed as a part of the deferred tax asset is the asset has to be represented. So you need to distinguish between current taxes and which have to be separately disclosed from current assets and current liabilities. So we have a separate line item called deferred tax asset or deferred tax liability in the balance sheet. And it should be disclosed under separately. It should not be disclosed under any of the other categories. It should be separately disclosed. And breakup of major components, like whether it is on account of property, plant and equipment, leases, losses, and etc., has to be specifically disclosed. So a good practice that I thought I would tell you is about keeping a permanent reconciliation, like at a balance sheet level, whatever is there. So that if you keep, I think this will solve both the disclosure purposes and you will also get an idea on how much asset that we are carrying on each of those components. So I think this is it on deferred taxes. So I'll be open for certain questions if you have any. Otherwise, we can close the session. If you have specific issues on deferred taxes, how do you compute, or any specific queries that you have come across, I'll be open to answer it if I know it. Otherwise, I'll surely get back to you on that.
Members can unmute yourself and come out with your queries if any. So I guess there are no queries. It was a very elaborate practical session with we have come out with a good Excel training session. So thank you very much. May I now call upon Acting Secretary J. Kritika to present vote of thanks.
Thank you, madam. First of all, thank you, sir, for accepting and delivering the CPE on a very short notice. It was a lively and perfect as a classroom session with examples then and there, enlightening all the required concepts for AS 22. We hope you give us even more time for many such technical topics for our branch in future as well. So thank you once again, sir. As far as the Cpe updates are concerned, next week, May 14th on Saturday, we have a one-day Cpe, which has been planned to cover the much-needed Companies Act compliance requirements on Schedule 3 amendments and CARO as well. And a very gentle reminder for the members to make their articles to be available for the upcoming Saturday knowledge paths for students, and which is starting from tomorrow. Please do encourage your students to attend those every Saturday, members. And tomorrow's session is a motivational thought topic by CA Soumya. Thank you so much for joining this CP.
Thank you everyone.
Thank you all. Thank you very
Thank you,
much, sir. It was a wonderful session.
Thank you, sir.
Thank you.